Jim, you have been the one who probably among this group feels that the Fed may be more aggressive. Is there any? Do you agree with what Bob just said, that another rate hike is very much on the table, and maybe this decision and this statement makes it even more so?
I think Bob's correct. I'm in his camp here. Look, I mean, the risk in the market is that the Fed continues to hike interest rates. I mean, is it likely that they keep rates higher for longer? Yes. And yes, bond yields are higher. Yes, the economy is cooling. But that kind of misses the point. Is inflation falling fast enough, and are they getting to target fast enough? And the question is that it might not be. So all I'm saying is that when we look at probabilities for the Fed funds, rate to move in December, it's, maybe in the low 20% probability that it happens. What I'm saying is that it should be closer to 50%. And I think that the Fed would be happier making the market think that. Now, that wouldn't be good news for equities. That wouldn't be good news for the bond market. But that's part of the solution for the Fed. So, yes, financial conditions have gotten tighter, and the Fed stated that. But as Steve Leisman said, there has been an upgrade to the economy. Things are kind of going the wrong way a little bit for the Fed. I mean, over time, I think that they might be right. But are they willing to risk inflation reaccelerating, becoming unanchored, and then having to come in more aggressively later? Or do they want to take out one more insurance rate hike? I'm just saying the odds could be closer to 50-50 for a rate hike in December, and we shouldn't misprice that risk.
And I think everyone has a different sense, perhaps, Jim, of what insurance is these days, depending on your view of where the economy is in 12 months. Let's bring Steve Leisman back in as he's been combing through the statement. Steve?
I like what Jim said there, that there is definitely the risk out there. There's a certain bias in here that is basically an unchanged bias. They added a little bit on the economy, but they also added a little bit to the downside when it came to financial conditions. I think that the story here is that they noted that their upgrade of the economy had to do with the third quarter. It wasn't a prospective comment. And so to the extent that Bob Pisani just talked about getting good news, and I don't like using that phrase when it comes to weaker economic data, but it was good news for those who are concerned about the Fed in the ISM manufacturing, also a step down in the ADP numbers, then that tends to rule out an additional rate hike. So I think we are indeed data dependent here when it comes to what the Fed is going to do next. And if that forecast for a weakening economy is the right one, which is the one again on the street, then I think we may have a third month of holding here.
So, David, let me ask you, is there anything in here, and you heard what Steve just said, is there anything in here that changes your view that the Fed is done?
No, I think it confirms my view. I think the two things. One, they didn't have to say that job gains were moderating because, frankly, we added 336,000 payroll jobs in the last print. That's not moderate at all. And so the fact that they said moderating suggests a little dovishness, but much more important, this slight nod to the fact that financial conditions have tightened with those higher interest rates. It's kind of like that's the last additional rate hike they might have done, or it's in the place of that. So to me, it says we acknowledge that, looking backwards, the economy's been strong, labor market's been strong, but we acknowledge that there's even more pressure in the economy coming from these higher rates. They're not willing to claim any progress in inflation yet. I think they'll see some more progress in the months ahead. But overall, this makes me feel more likely. I think it's more likely the Fed is in fact done and they won't have an excuse to tighten further.